welcome everybody to the September WITI Link SV session. So we track where the money went, what companies we should look to partner with, invest in, work for, etc. When did we start this, Bob? I think it was maybe end of 2020 or early
Yeah,
2021.
something like that. We were coming out of the dark ages from the pandemic. I think we talked about let's do something together for fun. Yeah.
Totally. All right, awesome. So Don, and I'm sure there's a ton to go over. I'm going to send it over to you and we'll keep rolling. Go for it.
Okay. Well, David, before I share my screen here, I will say I have a new deck today.
Oh,
I'm on a new tool, Gamma, which you know.
oh,
And I apologize in advance. There's not as much detail as I like, but I promise I will fill it all out over the weekend and send it to you, David, and post it on our webpage. So
okay.
with that, let's get started here.
Wow, your first
Need to
Gamma
share.
deck, Don. I guess maybe
Oh,
it's on
please,
the
David,
list.
new tools,
Yeah,
jeez.
can't wait.
Okay, so now I just need to, oh, come on here, Don. Of course, it's over where I get this out of the way. There we go. Okay, now. Okay. So to start this off, it obviously summer is over. We are back into fall. August under our belts, and it was the only slower month of the year. We pulled in a total of 4.2 billion in fundings, which was down from the more than 3 times that previous month. But the interesting thing was that even with that 4.2, what happened on the first day of September? Well, Anthropic came out and announced that they had completed, closed, and raised $13 billion. And of course, that wasn't done on the first day of September. So in reality, August was as big a month as the other months. So just a quick overview of the last 4 years and this year. You know, back in 2021 was the year of zero interest. Lots of investors who had never dabbled in VC and startups before. Private equity, much more than previously, but we got family offices, we got high net worth individuals. Everybody wanted to get a share of VC, and there was so much money out there that there was not a lot of due diligence. A lot of startups got funded that probably shouldn't have. And that came to a halt, obviously, when the zero interest rates dried up. 2022 was down by 50% in every area but AI. And we're going to be talking a lot about AI today. We actually did not track AI as a sector in 21 or 22. We picked up on that in 23. But as you can see, 2022, we were down by 50% to 73 billion. It went even lower in 2023 to 53 billion. And almost half of the money that went out in 2023 went to AI. Now, 2024 picked up. Again, money going out to AI, lots of money going out to AI. And big rounds. You know, these are extraordinarily big rounds. Mira Murati in 2025, she came out of OpenAI. She was their CTO, left and started her own company. Her seed round, now seed, this is about the earliest money that a company gets. Seed round was $2 billion. So AI takes the funding curve to a whole new level. Now looking at this year, we are 8 months through the year, and we are already at 121 billion. Now, needless to say, that's aided by things like OpenAI's 40 billion earlier in the year. But still, there's no question we will exceed in dollars, not in numbers, but in dollars, 2021. And this year, driven by that $40 billion round to OpenAI, we're at 70%. That goes a little bit down. As soon as Anthropic's raise hits, it'll go up again. The consensus, there's lots of available money for well-qualified AI startups. The frontier model companies continue to rake it in. We haven't talked yet about the non-AI companies or the smaller companies, what Bob would like to call or does call the other side of the river. That's another whole story. Lots of tough stories there. But let's go on a little bit now and look at breakdown here. So again, AI is the major portion of the pie. If you look at software and infotech, now break those two real quickly because AI for us is AI infrastructure. It's pure play AI. It's frontier model companies. It is the chip companies that are making AI chips to accelerate compute. It is the compute companies that are putting up data centers. And it's the tool companies all around everything in AI, the LLMs, the tools, the data. Anything having to do with applications, so vertical AI, horizontal AI, that's under software and infotech. And it translates also over to specific verticals, which I'll mention here. But as far as the amounts of money going out to different sectors, software and infotech carries everything AI that is an application and not in security, biotech, property tech, robotics, defense, those areas. So the four areas at the bottom here, we've seen an increase in activity. I don't need to explain why in cybersecurity. I think we hear of a data breach every day. Property tech. The property tech covers construction, and construction covers data centers, and there's a lot of work going on in that area. So all of these startups that are making improvements to it's the paperwork, it's the workflow, it's the work site, it is the materials. That whole arena has received a lot of funding. Robotics and industrial information automation has been fairly quiet previous year, but their development cycles have now hit the point where they are in beta or in some cases delivering. And some very large rounds are going out into industrial automation, which is factory, but it's also logistics, shipping. It is any place that an intelligent robot can do the job faster and safer than a human. And finally, a new sector for us this year, well, fairly new, we had a little last year, defense. And that's purely a reflection of changing priorities in the administration. But there's a lot of new money going into defense. And it's not just concentrated in Washington, D.C. It's Seattle, it's our NorCal and Silicon Valley. And then Colorado are the three main areas we see it going. So let's talk about the trends in AI applications, because we've really gone through three different sweeps now. We're in the third. Back when ChatGPT first came out, we're talking 22, 23. a lot of developers grab ChatGPT, they put a wrapper around it, they focused it on a vertical, and they put it out there. Those companies got some initial funding. That was the big thing out there at that point in time. But there's absolutely no moat. There's no unique ability with those companies, and most of them have either graduated to something else or a number of them have gone out of business. So the second span was the AI assistants, the reactive AI. You know, that was largely 20, end of 23, 24. And AI assistant became just a very vague term that indicated that whatever you were doing, AI could help you do better. And we're now in what we'll call the era of agentic AI. And these are AI agents who, if they do what they should do, can act autonomously, can complete tasks without your intervention. Again, AI agent has been used in a loosely by some companies, let's put it that way. The agentic AI we have seen now come into releases and get out into beta, get out into the point that they're scaling. Three main areas we see this and have seen this now this year. Customer service. This was probably the earliest, and it makes the most sense. Voice AI, as well as the assisted the assistance that AI can give to answering questions, solving first layer problems. You know, now agentic AI takes it further, and depending on which company you listen to the stories on, these AI agents can now solve as many as 80% of the customer inquiries, problems, issues that are brought in. The second area is legal. We're a litigious society. That's not the only thing here, but it certainly did, I think, contribute to the number of startups we saw and still see introducing AI infused, native AI integrated applications for different aspects, for litigation, for estate processing, for you name the area, it's there. And finally, this year we've seen serious advance in the horizontal area. And by that, I just mean general workflows for enterprise. These are, let's see, companies that are totally enterprise focused. The agents will be used by multiple departments, and they're now, the companies doing these applications are now getting serious. We're talking 100 million rounds, having proved it to scale it. So let's see. As a matter of fact, yesterday I think it was, we saw a $315 million round to Sierra Technologies. That's a serial entrepreneur. Brett Taylor has done multiple companies before, but they now have agents focused on customer service, and they are in, you know, a couple thousand enterprise companies. They're getting 300 million plus to be able to take it further, to scale it, if you will. Now, we are not yet seeing much in the way of scaling on the physical AI, but it's coming. We're seeing a lot of new companies using physical AI for a variety of areas. Can be security and physical AI. This is recognizing and taking action on whether it's objects, whether it's shipping and logistics is using it, ag tech is using it. we're seeing this in multiple arenas, even defense. We saw a defense company come out with an application for battlefield physical AI and weapons use. So the physical AI combined with robotics, combined with generative AI, is making serious advances, and by the end of the year, we expect to see these companies not just in production, but starting to scale. So, funding trends. We've seen some interesting things happening this year, some because of what is going on in AI, a lot of what is going on in AI, but also influence from outside the startup ecosystem. You know, AI infrastructure continues to pull in billions of dollars. Over on the biotech, medtech side, biotech has always been a very active sector in our area. It continues to be, but in the early stages, it has been hurt by the changes in the National Institute of Health, the grants that are going out, and we see right now more in the way of not later stage. We're looking at Series A, we're looking at Series B, less in the way of pre-seed and seed than a year ago. So healthcare, incidentally, is distinguished from biotech and medtech because it is the systems around providing medical, providing whether it's actual medical or providing the software to track the medical, providing the software to track the providers. That is all in healthcare, and that continues to pull a lot of funding. The first scaling we've seen now in healthcare, native AI, within the last 3 months, several transcription companies, and they seem to be the leading edge of what's happening in applied AI in healthcare. Multi-million, multi-hundred million rounds to be able to take their transcription software out to multiple companies. When I went to my doctor the other day, Kaiser is using one of those transcription companies. So, and adoption at companies like Kaiser is slow enough. You know, if they're using something, it's been around for quite a while. It also means that they've recognized it has a huge impact on their productivity, and maybe they accelerate because of that. Security and defense, I already talked a little bit about those. I won't spend any more time there. And David and Bob, please feel free to stop me if there's questions that are relevant.
Don, the only thing I want to pop in on is that for years, the healthcare sector has always been in vogue, whether or not we had a good market or a bad market, because older people like me wanted to invest in healthcare companies to save people's lives. There's so many people around there dying. So I think now with the advent, when software started coming in 10, 15 years ago, and now with AI, now we're getting people coming into healthcare because it's a great business sector. We've never seen such a land rush of companies coming in the healthcare sector, which I'm delighted to see. We see lots of startups in that area. Yeah.
And longevity, Bob, right? You put that in the same bucket? That's hot too.
I'm a partner in a longevity venture fund. Yes, longevity is all about things that are going to keep you alive and keep you healthy. And it has a very wide span. I'm talking to a company right now in agriculture that's going to help organic agriculture. That affects longevity. So So it's a pretty wide berth when you talk about longevity. Yeah.
Okay, all right, we're partnering with a big with Nick Larson's longevity conference. So I'm gonna have Michael say something about it. We're done with this.
Oh yeah, good.
Wait, but hold on, Deborah, Dr. Deborah
Yeah.
had a question. Go for
Quick
it.
question. Have you guys seen, because I know and I know AI like very well, and especially in the financial sector. One of the big areas that I see emerging that I haven't seen here, so I wanted to ask you all is AI ops. Observability, measurement. So, proving what the AI is actually delivering, how it's performing, is it compliant? That's a big area in the regulated industries. Have you seen, and most people have no idea how to do it. So, have you seen any funding around that?
There's funding around that as well as every other aspect of looking at tracking and controlling those aspects of AI. Yeah.
Observability, yeah, yeah.
Yeah. Explainability. There's a company out of Colorado that Bob and I are aware of that focuses on, as an example, explainability of AI specifically in healthcare.
Mhm.
So yeah,
Okay.
and actually that's a good point because most of those companies do focus on a single sector, not the whole range of AI in general.
Yeah. Oh, great. Yep. Got it. That's right. Because it's domain specific, but you're saying they're sort of folded in here to your numbers, right, Don?
They are part of if they're focused on a vertical, they're part of that vertical. For instance, we would report explainability in AI in healthcare as part of healthcare. Correct.
Hmm. Thanks. Okay, great. Thank you.
Lisa, I also want to mention, and talking to a bunch of doctors, people in the medical field, I'm getting to know. Think in football terms, when you get down driving toward the 20-yard line, getting in the red zone, AI is nice, but they want a human touch and human interface in the last few yards to make sure it's all correct. So there's a lot of concerns about what it actually delivers. But for a lot of research and things up to the 20-yard line, it's phenomenal.
Awesome. Thank you, Dr. Deborah. Okay, let's complete and then keep going, Don. And then we'll have Michael share about the longevity conference and then we'll do breakout rooms.
All right, fair enough. So I want to touch quickly on exits because exits are a huge part of the health of our startup ecosystem. So M&A this year started off slow. And it started off slow, and this is US-wide first, because of uncertainty about tariffs, about economy, about interest rates, about many things. It just held things up. The second quarter, things picked up in the US generally, and are expected to pick up for the rest of the year because of things like anticipating a rate cut in the next Fed meeting. Now, in the Valley, we had a little bit different experience. We had an increase immediately, first quarter of 25 in M&A, but in M&A numbers, not necessarily dollars, because the vast majority, on the level of 90% of the acquisitions we see, don't have dollars disclosed. They don't want to talk about it. And we can think about why that is, but they don't have dollars disclosed, but they're doing the acquisition anyways. So, and that has continued right through to today. We are just seeing double the acquisitions this year that we did last year. Now, this increase that's expected in M&A, there's one cautionary item there, and that is that the big companies, the Microsoft, the Google, the Amazon, we'll leave OpenAI out of it for now. These folks normally are very active in acquiring startups. That is likely not to be true or as true going forward because of the huge amounts they are putting into AI infrastructure. Each of those companies has committed and is in the process of spending something between 80 and 100 billion on their infrastructure. So, I mean, finite number of dollars. AI infrastructure spending at that level is going to mean a decrease someplace else. So on that issue, I think we'll probably be not as many as we might otherwise expect. Microsoft, as an example, has been very quiet in acquisitions this year. Now, where you would expect to see acquisitions happening are in the AI arena, and you would expect with the big companies for this to be very big exits, but a phenomena called reverse acqui-hire started happening. This is a year and a half, 2 years ago. And it has pretty much eliminated large acquisitions in the AI arena. Not to say there aren't some. You have companies like Weights and Balances being acquired by CoreWeave for $1 billion. But take a look at these. I mean, you have Microsoft, I can't say buying inflection. In each of these cases, what they did was the large company, Microsoft, Amazon, Facebook, or Google, basically invested money, paid money to hire away the founders. So Microsoft got the 2 founders of Inflection. They got their top research team. They paid $650 million for it. And they got some rights to some non-exclusive rights to technology. Amazon did the same thing with Adept and with Covariant, Google with Character AI, and Windsurf and Scale AI are the latest. You know, there's 2 issues here. One for the startup ecosystem. In most of these cases, what is happening is the founders and the investors are making off very, very well. In the case of Google and Windsurf, they paid $2.4 billion for Windsurf. All but a couple $100 million of that went to the founders and the top research guys and the investors. The rest of the employees in the company got nothing. A very similar thing happened over at Scale AI. Facebook hired Alexander Wang, their CEO, their top researchers, away. Yes, Facebook paid $14.3 billion for a 49% stake in Scale AI, but what's left at the company is it's more than a skeleton, but it surely is not got the intellectual research power to continue making the advances that you got to make to stay ahead in the AI arena. So this is my personal opinion, not healthy for the ecosystem, and it certainly has taken away a lot of the potential for large exits that would otherwise have happened. From the large company's point of view, it's faster to buy a team than to build it.
If I can interject something with
Sure.
regard to what you're saying, there's a new model now because of this that I've been reading about where, you know, many, I was a Fortune 500 lawyer, and typically you have change of control provisions where everybody's equity vests. Apparently, a lot of the early AI companies did not have that, and that's the reason you're seeing the top people. There's been a pushback now from regular workers, and because of the demand for software engineers and the like. So now you're seeing, at least with some of that on some of the newer deals, or the newer companies, you're seeing where all your options vest on a change of control.
Right.
So that's something that's pretty new in the past couple of months, and it was traditional. I mean, when I practiced law with a Wall Street firm in the 90s, that was standard operating procedure. It seemed to have gone away during the AI era, to my knowledge.
And it may be limited only to the AI companies because many of the startups I'm familiar with always had it in their
We
terms.
we always did. When I bought companies, I paid, you know, I grew both organically. I founded 4 companies with a couple of successful exits, including an IPO. So I did a lot of M&A as a founder and growing my companies in addition to organic growth. And I never encountered where I didn't, you know, where that wasn't a provision. So I was very surprised to see that many of the AI companies didn't have those change of control provisions. It's just maybe such quick growth. And not only that, surprisingly, you can, and I deal with this all the time as a consultant. Um, the last people that founders often go to are lawyers because they don't want to pay the fees. You know, good lawyers are expensive today. And, you know, I talked to somebody this week. They set up as an LLC instead of a C corporation. Now they want to raise capital. I see that all the time.
Yep, not surprising.
So anyway,
The
my
the
2 cents.
LLC is less surprising, not less encountered out here, but yeah, I totally agree. But anyways, this is bad for employees. This is bad for the ecosystem, and that's not an isolated opinion. You know, some of the VCs that have been involved in this have said they will never do business again with the founders that made the choice to leave their employees behind. Okay, moving on. And the IPO, of course, is the other exit. And we're not back to where we want to be yet, but we have made some progress. We've had some successful IPOs this year. The latest one, let's see, Figma, went out well. They're not doing so well now. They're down by about half, but still, they came out well. They had a big pop, made everyone happy to start. There are still 750 plus companies that are worth $2.75 trillion. Never had that many private companies and that value before. And they don't feel the need to rush to IPO. We see some continuing to go out. I think we'll see another 2 or 3 this month, tech IPOs. But it is unlikely that we'll see a robust IPO market this year. And part of the reason for that is, as we said, these large companies, not only do they have lots of cash and they can raise more, and Databricks raised $10 billion at the beginning of December last year. And as far as employees pushing the company to go public so that they can get some cash out, well, the companies are getting around that by doing secondary sales. They'll let the employees cash out half of their holdings. And on the investor side, secondaries are also becoming common because the LPs, their investors, don't want to wait 10 years, 15 years. And the 10 years used to be the standard. It's no longer. Many of these companies have been private and were founded more than 10 years ago. So at any rate, secondary sales are playing a much larger part in multiple places in the ecosystem. Okay, and I'll just finish off with a little bit on us. We're Link Silicon Valley, business intelligence on the startup ecosystem in Silicon Valley and Northern California. We put out a weekday newsletter, all of the fundings, exits, investor funds, new hires, and people, execs moving from company to company or company to VC. We've got a database that all that information goes into. It's been building for more than 25 years. And it is a rich resource for any small company that wants to be either thinking about, looking at, or in the middle of raising a pre-seed or seed round. We do a monthly fundraising webinar, and part of our giving back to startups, we offer what is generally a $50 package for service providers to entrepreneurs at $7 a month.
The
You
startup.
get details on our website. And with that, I'm going to turn this back to David. And thank you, David.
Thank you, Don, for all the info. We'll work on your gamma slides. I think, you're in the right direction, but I think I can